Hello and welcome to BQ Prime. You're joining us on this special broadcast where we're discussing a higher inflow into debt securities by foreign portfolio investors. Now, what NSDL data shows is that in November alone, inflows worth over 14,000 crore have happened as of 28th of November. Cumulatively in 2023, the calendar year 2023, the inflows have been close to 49,600 odd crore, nearing 50,000 crore. This is the highest level of inflows into debt securities by FPIs since 2017. That's what the NSDL data points to. This is quite interesting because this is coming on the heels of the announcement by JP Morgan of India's government bond inclusion into the emerging market index. To discuss this topic further and maybe get a few other market insights, I have with me Mr. Ajay Manglunia, MD at JM Financial Group. Hi, Mr. Manglunia. Welcome to this conversation.
Hi, Vishwanath, and pleasure to be here and happy to talk about this.
Right. So higher inflows now over the last, when I look at, say, even 2021 or 22, you had net outflows by FPIs in the debt securities. What has changed this year exactly?
So there are a couple of things which have changed. Like in the year 2022, there was the effects of pandemic and the currency was expected, or it was kind of weakening a bit, and people were not very sure whether they need to be stay invested in the emerging markets. So a lot of those who kind of could exit have kind of exited and were focusing only on some of those special situations wherein they get the high yields in the high teens and all of that. The emerging market flow, especially for India, started when people have started looking at it from the perspective of potential capital gain or kind of a lot of data stability in the sense that the economic numbers in terms of fiscal deficit and stability in the currency and all of those. And if you look at it in the whole of rate hiking cycle, India has outperformed the world. In the US, we have seen the interest rates moving from 0 to 5% and then now tapering off a little bit. But India didn't move at all. Rather, it has improved. The GSEC yields 10 years before the rate hikes were at around 7.65. And today, if you look at it, they are still at 7.25. So in all of that volatile environment, India has shown a lot of stability, a lot of strength as far as the investors' comfort is concerned. Drawing that comfort from is probably the potential FPIs who were looking to kind of put in their money with a perspective of stability and all of that have started thinking about it, and it has added fuel to the fire that JP Morgan has kind of considered to be India part of the global indices. And what it makes a difference to the investors is the fact that with getting included in the global indices, it becomes imperatively a compulsion for the people who follow that index. Now, with that perspective, they have to stay invested, and probably they know that once everything is set up, all the hundreds of investors will rush to buy those papers. Now, it's an aspect which we need to keep it in mind with respect to the volatility, and the central banks here is very, very conscious about volatility. Their idea is not to set a rate, let it be currency, let it be interest rates and all that. What they are concerned about is the volatility. So they were quick enough. If you might have noticed in the last policy, they have mentioned that they have an option to do almost sale. So central bank has always been proactive with the potential flows coming into the India will add a lot more liquidity, and all the effects of rate hikes may be washed away if you don't control the liquidity. If you kind of have a lot of liquidity in the system, it will feed into the inflation. So they were quick to announce that they will, and it serves both the purposes. It doesn't only contains the volatility in the yields, but at the same time, it will also take out the liquidity out of the system. So with all of those reasons, we've seen that a lot of investors who were looking to kind of invest eventually have started putting a bite of it.
Are these inflows, in your view, likely to be there for the long term, or will we have a few volatile months going ahead?
So every investor, Vishwanath, would like to start with the sovereign. And the sovereign, there's a far securities which are kind of predefined and investors can buy. Today, if we look at the limits are amply unutilized. And they can just quickly go and buy and inform to custodian to the to the RBI that they've invested so much. So there is a huge amount of inflows available, limits available, so they can eventually digest any amount of inflows. Now, fact is that most of those people who are coming to the FPI route, they will probably look at the securities which are in the tenor of 3 to 5 years, or maybe the benchmark which is 10 years. So we expect those investors to be in those buckets, unless until it's a pension fund or insurance company who can potentially look at the longer term. Because in the longer term, India still offers very, very attractive interest rates compared to all other markets where the rates are in the range of 3.5 to 4%. India still offers 7.5 kind of interest rates on sovereign.
Right. To your mind, sir, going ahead, are we likely to see then these inflows sort of influence the way corporates borrow money? Because we have seen that shift coming back to banks a little bit amongst domestic corporates.
Right.
But do you think that with the higher inflows, maybe they could look at foreign investors?
Definitely, the foreign investors are equally keen to buy some of those safer revenues in the corporate bond because they naturally provide them a bit of extra spread or and above the sovereign. And the thing is that they just don't have so much of capabilities to analyze corporate credits. So they may restrict themselves towards the quasi-sovereigns, which are kind of banks of the issues. So they may start with that. We have seen the earlier cycle wherein a lot of foreign investors were happy and comfortable investing in NBFCs which are rated AA and above. But eventually there will a path where they will eventually travel to. But the first attempt will be to bite as much as they can in the sovereign, and that's the way the yields in sovereign will travel down, and the spread between sovereign and corporate will widen a bit, which will encourage a lot of investors, not only the domestic but the overseas investors as well, to start looking at quasi-sovereigns and AAA SFR credits.
Okay, last couple of questions from my side. So at this point in time, there is no real expectation of the RBI raising the repo rate any further. Geopolitical conditions as well as the way the inflation is panning out, it doesn't seem like there's going to be any further sort of uphill path on the interest rates. But having said that, how long do you think these interest rates are going to continue? Because the question is, when does the tide turn? And it doesn't seem to be clear as to, people don't seem to have one consensus view on when that tide is likely to turn.
So I don't expect any rates cut action to happen in this financial year. And people are talking about resuming the rate cut cycle only when you see the need for growth. And this abnormal rate hike environment has been there since about more than a year now. And we see the impact of those rate hikes by way of some bit of pressure on the growth side. So once the government starts realizing that there is a need for focus on the growth and we need capital for the growth, potentially at that point of time, maybe one or two policies after the next financial year. So everybody is convinced the way the inflation was, it requires a lot of stability and one should not be in a hurry to cut the rates. Correct. If you start cutting the rates early, the impact of rate hikes, which you were expecting, will shortchange. And that's the reason everybody is convinced that the rates are likely to stay higher for longer. But higher for longer, how much? So people were expecting from the last pause, at least 1 year, the rates will stable. So we have already seen in the last three policies, potentially RBI didn't do any rate hikes or any further talks about the hikes, but they were always hawkish. They didn't want people to get relieved and start punting in order to assuming that the rate hike cycle is over. So the effect of rate hikes is still getting transmitted and probably it will be taking some more time. I see a possibility of rate hikes only in the next financial year, but the market is always slightly quicker, Vishwanath. So they will start factoring the rate hikes. So before actual rate cut happens, we will see that the market will start discounting it 3 to 6 months ahead of it. So we'll see those effects only after the budget and after this policy post-budget. There will be some bit of relief to the marketplace and they will start building up positions with the effect that in 3 to 6 months later, rate moderation will start.
Lastly, on the 10-year benchmark in India, so that's been ranging. You mentioned earlier, it's been ranging between the 7.2, 7.3 sort of range, and it's remained tepid. The movement is not very sharp.
Hmm.
Do we continue seeing that going ahead, or
I
could
see a
something
big
change?
hurdle. I see a big resistance at 7.37, and from there, the yields have tapered down a couple of times. So
Yeah,
I don't see yields going below 7% in a hurry. At least in this financial year, I don't see yields traveling down below 7%, and they are unlikely to cross 7.37 in a hurry.
right.
So it is likely to be in the narrow range of 7.10 to 7.3 to be precise, and that's the way we will see, unless until there is a now the thing is that the data which are coming up are very, very volatile. It's not
Yeah,
in a one direction. And
yeah,
these are kind of throwing a lot of surprises. And that's the way most of the central banks have been commenting on those. Sometimes they are moderating, sometimes they are kind of bullish. So
mm,
with those things, unless it is the stability on the data comes back, we don't see this volatility to get
yeah.
contained. So I see 10-year to be in the range of 7.1 to 7.3 for some time.
Because the upcoming GDP data also, I think, with the
They're
comments of the
likely to be
RBI
more good.
governor, yeah, looking better. I think that's sort of confusing the market a little bit. But
Yes.
thank you so much, Mr. Manglunia, for joining us on this conversation. A pleasure talking to you, sir,
Always,
as always.
always a pleasure, sir. Thanks a lot. And
Thank you.